Hey, this is James in the Giant Economy. Thanks for tuning in. Today we're going to look at real estate interest versus energy interest. In other words, I'm going to go over the 5 houses that I sold to put into energy interest, right? And I've got the numbers up here. We're going to see how much equity I missed, how much rent I missed, what the total of that is, and then we're going to see how much I've made for energy, and we're going to see if it's worth it, right? So let's buckle up, and we're going to go through the numbers. All right, so here is, I just looked on MLS. I actually did this all in the first video, but then it crashed it, so I'm like, great. But long story short, I looked up all of the housing data on it to see how much were rents in the area, how much did it sell for, and everything. So, 2718 Indian Ridge, I bought it for 150 like 10 years ago, sold it for 285. That's 135 in equity. The sale price now, when I went back and looked at it, is 315, right? So I sold it probably about a year ago, summer of 2022, 2021 maybe. Yeah, man, I gotta look back. So 2022, and so here's the equity I missed, right? Because I sold it for 285, but then the value of the house might have gone up a little bit, or at least this is what MLS says, to 315, right? So the equity that I missed was $30,000. Now, rents at the time were about $1,700 when I was renting it out, and rents now are $2,100. So if you times the difference times 12, right? 1,700 or 2,100 minus 1,700 times 12, you get $4,800. So in the last year, I have missed $4,800 in rents. And if you count equity, so after that year, if I was sold it right now, if I could at the average price, I would gain another $30,000, and that total comes to $34,800, right? So that's what you can see on this this graph. I did it for all of them. There are a few ones that are a little like Brown Lake. I owner financed the one out, so this is the owner finance pricing. It doesn't really reflect the interest rate I've got on it or the money I'm making on it currently, but I will tell you I only pulled out like $54,000 out of it for the down. But the everything is staying the same on these numbers. So the missed equity, if I had put it on, and again, this is not counting repairs or anything like that to put into it. This is not counting realtor fees. This is not counting holding costs. So there's a lot on the real estate side that is really, I'm really pork barreling that, right? We're rounding up in favor of real estate because I'm not taking all the time to go to the details and look at all that in a minutia. Just know that this is heavily rounded up. Rents were $2,100. Rents now are probably about $2,650 if you can strike the negotiation with the tenant type thing. The difference in rents for over a year is $6,600, and when you wrap in the equity of that, you get about roughly under about $60,000, right? So, and here are the corresponding tracks. So when I sold Round Lake, I put it into Encore. When I sold Indian Ridge, I put into the Cattleman one. When I sold Clover Ranch and Ringfield, I put those two into Foundation. And my darling one, when I sold Taylor House, I put it into Miller. So let's take a look. So in total, in rents, I'm missing $23,000, right? The cash flow that I've had here in minerals is about $150,000 in the last 12-ish months, right? 12 to 18 months. So another one for, where was it? Taylor House, I actually did the rents times 18 because I've had it for I've had Miller for 18 months, so that's what I missed. So again, I'm doing everything I can to round on real estate's behalf. But the cash flow I would have had is about $23,000. The cash flow from these mineral tracts is just under 147,000. So right there, just right there, I'm like, I think I made the right choice by putting it into minerals, right? What about the equity, James? The equity, it's all about equity. Well, I would agree with you to a point. So equity, again, they're rounded up, and I sold it at the right time, top of the market, could time it, not counting real estate fees, not counting realtor fees, not counting the rehab and everything. Again, rounded up, I'm missing about 190,000. Sorry, I'm missing, so equity-wise, let's do this. So just missed equity, I'm missing about we'll say 170,000, okay? 170,000 in equity. In equity here, I just totaled these three up, right? Because I didn't even put foundation there because it's the same. But I actually gained about 450,000 equity, right? Now, how to come to that conclusion? It's pretty simple. The average investor, if they're saying, hey, I'm going to buy something with a 10% yield that's totally passive, you know, I don't have to worry about anything. What I do is I take the initial investment. I've got an estimated return this year of about 20%, give or take. And then what I do is I would basically deduce that into 10% and raise the invested amount accordingly, right? So if I bought it for 100,000 and I'm making 20%, to sell it to someone at a price to where they would pay to make 10%, you would double it, right? So if I'm making 20,000 a year off this, I'd sell to someone for 200,000, and they would make 10,000 or 20,000 or 10% of what they bought it for. Now, I did round down a little bit because negotiations happen, et cetera, et cetera, et cetera. And again, I'm trying to give real estate the push for everything it can to make this undoubtable, right? So I times it by 1.75. Okay, so I times that by 1.75 instead of 2 because that was, you know, 20% to do that. So came out to 177,000. Grand Finale I didn't put into that because none of the tracks correspond to it. But same thing with Encore because it is getting about a 20% return. And then Cattleman's got, that guy just went off, right? So right now he's at 28% currently just this year, but I'm going to round down and put him at 20% like the others, or times it by 1.75, right? So as you see, I've got 450,000 in excess equity, right? So yeah, making sure I did that right. So I minused it by that. So right now it seems like minerals are really winning type thing. James, what if the price of oil and gas goes down? Well, it has. It kind of goes up and down, right? That can happen. But here's the big thing. I am outrunning these guys so much on cash flow, right? I am doing, let's get some math up here. So 23,000 divided by 147,000. Right. Something on my. This is 15% of what I'm making right now. So I'm doing quite a bit more. Divided by 23,000. Yeah, I'm doing like 6 times more cash flow, and that's rounding down. You could say 6 to 6.5 times more cash flow from these guys than I am from the houses. Right. They have equity too. It goes up just the same type thing. So I think I made the right choice. Now, here's the key issue. I bought these guys at really good deals, right? I bought them anywhere from 12 to 5, I would say 5 or 6, 7 to 12 years ago, right? They have appreciated. Okay, the big thing now is that would I buy a house right now? The answer is no, because I don't know if it's going to appreciate much, right? But like, well, James, I'm just here for the cash flow. Well, so am I. I'd rather do 6 times the amount than this, right? The only difference is these are very easy to leverage. Houses are very easy to leverage. People giving mortgages all day for everything. With minerals, it's a bit harder, right? Oil and gas interest is a bit harder, and that's one reason why the $1 goes so much farther with minerals is because there's not a lot of people lending, so there's a bottleneck in it, and so your dollars go even farther. Honestly, especially from being a landlord for so long, I would say unless your property is going to appreciate and at a decent rate, it's not even worth the cash flow. Unless you're making $800 to $1,000 a month overhead, it's not really worth it because one tenant can come in and do some damage like this one, right? I had to undersell him because the tenant did so much damage to the property, and I wanted to get it off my book so I can put it into this. It's one of those things to where they did like 30 to 35,000 damage or something like that, and the cash, the amount that I got, the equity, that's the only reason excuse me, it was for this one, sorry. the equity is the only thing that really brought it up to make it worth it, right? Because for rents, if I had owned it for, let's say if I had owned it for 5 years and I'm making like $500 a month, right? 500 times 12, and for 5 years, yeah, one tenant can do $30,000 in damage. It's not really worth, unless there's equity and appreciation, it's not really worth it, right? You can go after the tenant, yeah, best of luck with that. It's not very fun. It's going to cost you more money. It's just one of those things, right? I like minerals because there's no tenant. Well, they are tenants. They're million to billion dollar oil and gas companies, right? There's no liability on our part. I don't have to fix leaky roofs, leaky toilets, complaining tenants. I don't have to deal with all that stuff. I don't have to put it on the market to wait and pay a realtor or anything like that. And it's just amazing, amazing cash flow, right? So will it be another time where I go back into housing? Yeah. If these prices get back down to here, or maybe halfway, right? But they're up here right now, I'll do it, right? And my hope is I can sell these, cash in a bit of this equity, right, and plug it back into housing when it's low and let it go up type thing. So that's my hope. Again, this has just been a comparison of real estate to oil and gas, looking at the numbers. If you got any questions on this, let me know. This is what I'm enjoying right now. Also, I'm enjoying the nice break from tenants and toilets and such like that. It is actually quite refreshing, right? Because as an investor, I'm like, it doesn't matter what I put money into. I just want it to give a good yield back, especially for my time and energy. So if you have any questions on this, feel free to contact me. But this has been my video. Hopefully it's helped you see that, hey, cash flow is definitely right now worth it in the energy space, especially when it comes, and also when it comes to equity, right? Even if I'm off this by 50%, right? That means it could come to about 200,000 or something like that. It's still more than the equity that I had missed in the properties. So if you got any questions about this, let me know. If you have interest, let me know type thing. But my name is James. This is the giant economy that we are in. Thanks for tuning in, and let me know what questions, comments you got. I'm here to help, right? With that, I hope you have a wonderful Memorial Day. And remember, Memorial Day is for those that have fallen, that have paid the ultimate price. Veterans Day is for the ones that are still with us. So happy Memorial Day.